Hey everyone, in this video I'm going to compare two of the hottest AI stocks in the market today and answer which one I think is the better buy. SoundHound AI versus super microcomputer stocks. So without further ado, let's get into this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so one of the first metrics I'm going to compare these two AI stocks on is revenue growth. But before we do that, let's take a look at the total addressable market for AI. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. Now that you understand this massive opportunity, let's look at the latest revenue growth. Supermicrocomputer delivered 103% revenue growth in its latest quarter, and that's been rising significantly. Investors expect this to continue for at least a couple of quarters more, and I'll share that with you in a little bit. SoundHound AI, meanwhile, delivered 18.61% revenue growth in its latest quarter. That's year over year. If you look quarter over quarter, SoundHound AI increased revenue by 52%, and its prospects are also excellent for the next couple of years, which I will also share with you. The next metric I wanted to compare these two on is the operating profit margin. Supermicrocomputer generated a 9.4% trailing 12-month operating profit margin. Meanwhile, SoundHound AI generated a negative 211% operating profit margin. That's a huge negative. Now, SoundHound AI management understands it needs to get its costs down. That's why early in 2023, it implemented a restructuring cost decrease, and that's proving to be beneficial. As you could see, its operating profit margin is making huge strides forward. Even though it's negative, it's making significant improvement. Now, I often say on my channel, I don't mind companies with negative profitability so long as they show me they're making progress in the right direction. SoundHound AI is definitely doing that, showing us progress towards profitability and rapidly improving progress. Now, looking over the next couple of years, let's go with Supermicrocomputer first. It's expected to continue to deliver 103% revenue growth all the way through June of 2024. In 2025, fiscal year 2024, which ends in June of 2025 for Supermicrocomputer, its revenue is expected to slow down to an increase of 39.7% and then a further huge slowdown to 6.6% revenue growth in 2025 for Supermicrocomputer. Meanwhile, for SoundHound, it's expected to deliver 50% revenue growth in fiscal year 2024, which ends on December 2024 for SoundHound. And for 2025, it's expected to deliver 43% revenue growth, which is expected to end in December of 2025. So while in the very near term, Supermicrocomputer has better growth prospects compared to SoundHound AI, in the medium term, SoundHound AI has better prospects compared to Supermicrocomputer. So moving on, I wanted to share with you the comparison of cash flow from operations to sales in the trailing 12 months. And in this metric, you can see Supermicrocomputer negative 1.47% and SoundHound AI negative 195.7%, similar to its operating profit margin. But again, like its operating profit margin, SoundHound AI is showing rapid improvement towards becoming cash flow from operations positive. However, there's still a long way to go for SoundHound AI to deliver positive cash flow from operations. And finally, I wanted to look at valuation, but let me share with you why I chose the price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were 185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for 465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. So now that you understand the price to sales ratio, you can see looking at this metric, Supermicro Computer is trading at a forward price to sales of 2.511, which is only a fraction of the forward price to sales of 13.06 that SoundHound AI is trading for. So SoundHound AI is roughly 6 times as expensive as Supermicro Computer according to this metric. So all things being considered, we looked at its revenue growth over the previous few years. We looked at the profitability, the cash flow, and we looked at the prospects over the forward few years. And we realized that while Supermicro Computer has done a better job in previous years, that SoundHound AI has better prospects for the next few years. However, all that being said, I don't think SoundHound AI deserves this much of a premium valuation over Supermicro Computer stock at this point, while it is making excellent progress. So if I had to choose today, if I had to choose the better AI stock to buy, I would choose Supermicro Computer, although I will say SoundHound AI is making great progress. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.